I'm Charlotte McLeod with investingnews.com, and here today with me is Brien Lundin, editor of Gold Newsletter. Thank you so much for being here. Great to have you.
Always a pleasure, Charlotte.
Yeah, so nice to see you, and we're here in person at the Rules Symposium. We've made it at this point, I think, a couple of days into the event, so I think it's safe to ask you about any takeaways you've had so far, interesting conversations, things that you would pull out.
Yeah, always interesting conversations. This conference has great attendees, really smart attendees, wonderful speakers. So really a whole lot like my conference in New Orleans. Really smart people here, up in all the developments, market developments, geopolitical developments. So already had a lot of really interesting conversations. People obviously wondering what's happening with the metals and what's driving it. And I guess we're going to discuss that right now, aren't we?
We will get into that. So we're catching up from our last conversation all the way back in March. So I went and checked. Gold was actually still above 5,000 at that time, although I think it started to decline pretty soon after that. So during that time, there was a lot of talk that I was hearing about how we needed to have a correction in the gold price. But were there surprises for you in how it played out?
A little bit, not really. You know, we had that big drop in January because of Kevin Warsh being appointed, the washout, as it were, and then we recovered largely, or most of those gains over the next 30 days or so. Then we had another big drop because of the Iran war erupting, and we've been kind of trying to work our way through that in markets ever since. So I remember in January some people telling me about how crazy it was, gold over $5,000 going up toward $5,500. And I made the point that, you know, this kind of reminded me of the 1970s, that we had a quick run up in the early 70s, then we had a 50% correction midway in the 70s because all of the bad things that everybody was predicting when the U.S. got off the gold standard or the gold link, and that they didn't really happen. Everything just kind of kept going okay, so people sold gold, and then all of the bad things did happen in the later 70s. So my idea then was that maybe we won't go down 50%, maybe 25%, because we have all the central banks buying. And that's precisely what happened. This was just an idea, but apparently I spoke it too loudly, and karma heard, and that's exactly what we've had. But it's typical. Now we're experiencing a typical metals bull market where you have 20-25% corrections, even more so in the mining equities. And then you recover because the overall trend is still up. The fundamental factors are still in your favor. That's exactly where we are right now.
I think it's reassuring to make those comparisons to previous decades because we can look back and see how it played out. For you right now, you mentioned some of the things that are going on right now. What would you say is the main headwind for gold?
Well, the headwind is trying to get past the two things really now, the Iran war and that effect on geopolitics and the risk, because gold is trading as a risk asset now because the Western investors are involved. And also the other thing is the newly hawkish Fed, or the perception in the market that the Fed is going to be hawkish. I think the overriding factors of debt and deficits will force the Fed to be more lenient, easier money policy, that they really can't afford to raise rates. Hiking rates really cuts off the demand component in an economy, and that's not what's driving inflation right now, so it would be ineffective in any case, but it will definitely exacerbate the problems of deficits and debts that they can't afford to do. So I think they're going to end up having very likely a cut this year rather than any hikes. So I really see both of those issues getting resolved almost as we speak.
That's really interesting, especially on the points about the Fed and Warsh. I've heard so many different ideas about what could be coming. So for you, you don't think we'll even get to one hike. We're just going to get, before the end of the year, we're going to start going back down.
I think so. I think the hike would be ineffective. It wouldn't do any good. I think what they're going to do is redefine inflation down. He's already talked a bit about that with the task forces, et cetera, and focusing more on productivity, So I think once again we've seen in the history of the CPI that they rejiggered it 2 times at least to dampen the reported inflation, and he's going to do that again a 3rd time. That's the way I think he's going to get inflation, at least the inflation metrics, down.
Yes, because all of this hawkishness is really stemming from inflation concerns. So that would be a very tricky way to resolve that. What do you see playing out for actual inflation as we go forward this year?
Well, I think we're going to see more of commodity-based inflation. We're here at basically a commodity investment conference, and the bull thesis for all of these companies and all of these commodities is that prices are going to go up. There are macroeconomic reasons behind that. The fact that fiat currencies have to be devalued in an era where debts and deficits are unmanageable at higher rates. So these currencies have to be devalued. There's also fundamental factors. There are also fundamental factors driving each and every metal, each and every commodity that come around generationally. We have demand curves that are perhaps among the steepest we've ever seen for a number of commodities, copper in particular, and severe supply constraints that those demand curves are running headlong into. So I think commodity inflation is something that will be, out of the Federal Reserve's or any central bank's ability to corral, and I think that's going to have an impact on reported inflation.
That will be very interesting to see how that plays out. And I'm glad we're going in the debt direction. I know it's a big concern for you as well as for others at this conference, especially. I wanted to check in with you about it because we're talking just after July 4th. And there was a lot of, well, at least some degree of talk leading up to that date about whether the U.S. might revalue gold. Maybe that helps the debt situation in some way. It didn't happen, but is that something you could see playing out in the future?
The U.S. may revalue its gold reserve. It's a fairly easy thing to do. It makes the balance sheet look better in terms of assets versus liabilities. But other than that, may give a little more leverage to borrow more. But I don't think that's the sort of thing that really fools the market. We know what gold is worth. We know it's not worth $42 an ounce. And the U.S. is already running into some difficulties in terms of financing debt and deficits. 10-year yields are rising for the dollar, even though, as we speak, there's been kind of a reignition of the Iran war. Oil prices are still far below where they were at the height of that concern a few months ago, yet the 10-year yield is almost back to where it was before then. You look at 10-year yields in Japan, France, Europe, they're all rising. I think that's because the markets and investors recognize this fundamental debt and deficit problem that we have.
I think that's a good way to explain it. And I think in general, people tend to focus a lot on the West when it comes to talking about gold. But you've been posting recently about how Western traders are making the gold price, but China is taking that gold. So can you unpack what you mean by that?
Yeah, we saw that Western investors finally got involved in this bull market around about a year ago, late summer roughly of last year. And that brought more of the typical volatility that we see in a bull market. The central bank buying had been the big driver for the market up until then, and now it's become more of a support. That central bank buying, particularly from China, has ramped up as the Western traders and investors have brought this kind of volatility to the market. Gold prices went down with all other risk assets, with the Iran war, with the washout, the fear of a hawkish Fed. And that does not factor into the calculus of Asian investors, China in particular. So if we're willing to put gold on sale on the discount rack, then China's very happy to take gold at those prices. And as we've seen, more gold, they're actually ramping up their purchases. The last reported monthly purchase was the highest since 2023. And that's their reported purchases. We know that there's much more beyond that. So yeah, the West is re-seized the price-making portion of the gold market, and Asia is very happy to take gold on sale.
Do you think that eventually we transition to a point where China they're taking the gold, but they're also doing more of the price making for gold?
Well, we've seen that in the last
Yeah.
few days as they started the Hong Kong exchange and really ramping that up. So I think they will. I think they want to be more in charge of that. But I think that's more of a national status kind of a thing. If we're willing to send gold from the west to the east at lower prices, they want to accumulate it.
Yeah, it definitely sounds like that will be a trend we should follow. I think let's talk a little bit more about the gold price in 2026. So one thing that I find our audience really is curious about is the bottom in yet for gold? It sounds like for you, maybe it could be. And then, of course, how does the rest of the year look? And you're mentioning these couple of things that are holding the price down look like they will resolve in the near-ish future. So how do you see 2026 playing out?
Well, I see, I think we have hit the bottom. I think we hit the bottom on June 24th when gold dropped below 4,000, created that death cross where the 50-day dropped below the 200-day moving average. And I was fortunate enough to say that to my gold newsletter alert readers the next day. But I may be wrong, and very well could be, because it's rare that you see a bottom in a market as being a one-session event. It's more of a process, a rounding bottom kind of a thing. And if seasonality is in effect, it doesn't work every year, but in the years it's in effect, then we tend to have gold in particular bottom around this time, mid-July to mid-August. And that's really our last chance, our best chance to buy the metals and the miners. And I think that's one of the themes I'm going to be presenting in my talks here, is that this is the buying season. This is the time to get ahead of the market, get ahead of the people who are going to come back to their offices and trading desks after the summer and find the gold price 10% up, maybe 15% up from where it was at the summertime lows, and some of the mining stocks up 30%. If you buy now, those are the kinds of gains that you can get when seasonality works, and it looks like it's working this year.
Right. I did really want to talk about your presentation here. It's how to play the next leg of this bull market. Is there anything else you can say about that? I think everybody is wondering what they can do. So don't sell in May and go away. Sounds like the first step.
Well, that might have been a good thing to do this year, sell in May and go away for at least a month or two. But that would have been a good strategy if you're a trader. I'm more of a long-term investor. I look at these long-term trends that really demand much higher metals prices over the long term, and therefore much higher prices for the mining stocks in the sector. One of the big themes of my presentation is that this kind of volatility is here, and it's here to stay now that the West has finally gotten involved. I bring up a chart, or will bring up a chart of the XAU mining index through the 2000s, where you see that we not only get corrections like we have now, 25% on the metals prices, 35, 40 on the mining indices, you get them repeatedly. And the convictions of the bulls have to be tested by a market, and they will be. And over the course of that bull market, when gold went up 8 times, you had a number of corrections where you really had to be convinced of the overall trend to stay involved. And if you were, then you really profited much better at the end of the process.
So I wonder, are you seeing buying opportunities across the spectrum, for example, for the gold companies from the juniors up to the majors, or is there a particular area that you would focus?
Yeah, I see it across the board. It really is a target-rich opportunity for the speculator right now. This is one of the rare times, if not the only time in my long career, that I've seen the majors actually offer the kind of potential of junior miners and junior mining discovery plays even. The majors are making money hand over fist. As I said, $4,000 gold isn't a bad place to be. You have tremendous margins like we've never seen for gold producers. And very shortly, a good portion of all of the major producers, if not the majority, are going to be net cash. They will have wiped out their debt. They'll just be building up cash reserves. Yes, putting some of it out in dividends and buybacks, but when their coffers get filled with more and more cash quarter after quarter, they're going to start looking for things to buy and putting that money to some use. And then it's going to filter back down the food chain into the juniors in more of a classic bull market. This has not been a classic bull market to date.
Right. I remember you said earlier this year, this is a unique type of bull market. And
Yeah.
I was wondering if it's impacted your strategy at all. It sounds like perhaps it has.
Yeah, it has. I'd like to. I have not been, frankly, but I'd like to focus more on the majors because of the opportunity that they offer at these levels and the money that they're bringing in. But it's been unique in that for the first 18 months or so of this bull market, the Western investors were really uninvolved. The central banks were driving a nearly relentless rise in the trend line where the so-called corrections were more of sideways trading ranges where we corrected in terms of time rather than price. Those halcyon days are behind us now. We are in more of a typical market where we're going to have this volatility testing our theses and our premises. But yeah, I think it is a buying opportunity right now. And the lesson of past bull markets is that when you get this kind of volatility, if you're in a long-term bull market, you need to buy the dips. And by corollary, you need to sell on some of the more fevered rallies that occur as well.
Yeah, which is a part that people might sometimes forget.
Forget.
All right. Well, I always love to hear about gold, and I tend to focus on that. But any other areas of interest for you this year? I know you tend to like copper as well,
Yeah.
which is having a good.
Yeah, copper is the long-term, slow but sure bull market out there. I think it's the most certain of the bull market theses that we have. It's very difficult, if not impossible, to innovate around copper. It's in everything. Its supply constraints are well known. It takes 15 years, in some cases decades, to get a significant copper project into production. So copper is that story. I think it's a set it and forget it kind of a thing. Silver will leverage gold. This is the first time in my career where I've really given any credence at all to the industrial demand for silver, because I've always believed its price is really driven by monetary demand on the margins. But we're getting to the point now, or really have gotten to the point now, where industrial demand is removing all of the newly mined supply from the market. And if you have that monetary demand associated with gold, and you have supplies removed from the market and taken up by an industry that's willing to pay far higher prices, that's a dynamic that really accelerates what is already a very volatile and very torquish investment.
Well, interesting to hear you change your thought process on silver a little bit. And because you mentioned it, I'll throw in my fun question on silver that I'm asking people. I see a lot of our audience also wondering, all right, has silver established a base at $50? And then on the flip side, a lot of people wondering, do we get back to triple digits this year?
I don't know this year if we get back to triple digits. I kind of hope we don't, frankly. I'd like a little slower but sure bull market than what we saw earlier this year. I think if you look at that $50 base, that was resistance for so long. I saw somebody post the chart in recent days that it's the strongest foundation, technical foundation of any commodity, perhaps in history, because it goes back literally decades. So yeah, I think that's a floor. I think that's the big floor. And that's not to say that the metal's not going to test it just to test us. But if it does, I think it'll be a brief break and right back above it.
That makes a lot of sense. All right, well, I will send you back out onto the show floor. Any final thoughts? I know you've got your own conference coming up in the fall.
Yeah, we see the reaction here. It's been great big crowds here. We've already got big crowds coming to New Orleans. Our exhibit hall is going to be sold out within days at this point. The registrations are coming in fast and furious like we haven't seen for many, many years. So it's going to be a blockbuster event. We've got a tremendous roster of dozens of today's top experts. It's in New Orleans. It's lots of fun. We end on Halloween, and so it's going to be a really special year, a lot of opportunities, and I really encourage people to go to neworleansconference.com as soon as possible to register and secure their spot, because we will sell out our hotel block.
Well, we'll look forward to that one. We'll have the details in the video description. And thank you so much for coming on to talk about what's going on in the sector. This was great.
Always a pleasure, Charlotte.
Of course. And once again, I'm Charlotte McLeod with investingnews.com. And this is Brien Lundin of Gold Newsletter.